For years, silver was treated like a sideshow in global finance, a volatile metal favored by retail traders and inflation hedgers, but rarely taken seriously by mainstream institutions. Wall Street dismissed it, media outlets ignored it, and central bankers spoke about it only in passing. But that narrative is now breaking because silver is no longer behaving like a simple commodity. It is behaving like a stress signal. When a monetary metal begins flashing stress inside a highly leveraged financial system, professionals stop laughing and start watching liquidity. What has changed is not just price direction, but price behavior. Silver did not grind slowly upward. It moved aggressively in a tight physical market, at a time when funding conditions were already fragile. That combination is dangerous because silver is deeply embedded within the collateral structure of modern finance. It sits inside futures markets, backs exchange-traded products, is hedged by mining companies, and is pledged within swap agreements and structured derivatives. Most importantly, it is leveraged. When price moves sharply in a leveraged market, the issue is not sentiment, but margin. Every dollar increase forces counterparties to post additional cash immediately. Clearinghouses do not debate narratives. They calculate exposure and demand payment. When margin demands spike during a funding-sensitive period, the strain does not remain isolated inside a metal's desk. It spreads through interconnected balance sheets. The same institutions shorting silver are active in treasury markets, currency swaps, repo funding, and interest rate derivatives. Everything is connected. Liquidity stress rarely announces itself with dramatic headlines. Instead, it appears quietly through jumps in overnight borrowing, unusual expansions of funding facilities, or emergency injections framed as routine operations. When those events coincide with a sharp metal rally, professionals see correlation, not coincidence. Silver surged, funding markets tightened, emergency liquidity was tapped, and the Federal Reserve stepped in without speeches or press conferences, simply with money. That is the signal. Central banks do not inject liquidity unless someone needs it, and when that need arises during a commodity rally, it suggests leverage was deeper than expected. Silver did not break the system. It exposed pressure within it. Exposure forces choices, and the Federal Reserve now faces one: defend liquidity or defend currency stability. In a debt-saturated environment, protecting both simultaneously becomes increasingly difficult. This moment is not about a price milestone. It is about a funding system reacting to volatility in a strategic monetary asset. The system can tolerate turbulence in equities or speculative assets, but volatility in a metal that underpins collateral structures hits differently. When structural assets move sharply, systemic pressure rises, and the Fed's swift liquidity response confirms that it understands exactly how fragile the plumbing has become. Modern finance does not run on deposits and savings. It runs on leverage. Futures contracts allow control over thousands of ounces of silver for a fraction of their full value, and banks hedge exposures using margin that represents only a small percentage of total notional risk. As long as price fluctuations remain contained, leverage functions efficiently. But when volatility accelerates, leverage becomes a destabilizer. If a major institution is short silver and price jumps several dollars in days, the losses are not theoretical. They are marked to market, and additional cash must be posted immediately. Failure to meet those demands triggers liquidation, and liquidation drives price higher, creating a margin cascade. Now imagine this unfolding. While treasury yields are unstable, credit conditions are tightening, geopolitical tensions are elevated, and dollar funding markets are already sensitive. Margin calls do not care about macro narratives. They demand liquidity. In stressed markets, liquidity is scarce, and that is when the Federal Reserve becomes the lender of last resort. It does not matter whether stress originates in housing, technology, crypto, or metals. If funding markets seize, the Fed responds. This time, the stress signal came from silver, a metal that sits at the intersection of industrial demand and monetary psychology. Unlike gold, silver is heavily used in manufacturing. Yet, unlike purely industrial metals, it carries monetary history. That dual identity makes it uniquely volatile when supply tightens. Physical inventories have trended lower, delivery demands have increased. Retail premiums have widened, and paper trading volume has continued expanding. This mismatch creates fragility because paper markets assume physical supply is abundant, while physical markets reveal tightening availability. When demand persists during rallies instead of fading, the traditional suppression mechanism weakens. Banks can sell contracts, but they cannot create metal. Rising delivery pressure during price acceleration makes short exposure increasingly toxic, and toxic exposure demands liquidity. When the Fed injects liquidity to stabilize funding stress during a metal rally, it weakens the currency, and a weaker currency pushes metals higher, intensifying margin pressure and requiring further liquidity. This feedback loop is mechanical rather than conspiratorial. Print to stabilize leverage, currency softens, metals rise, leverage stress intensifies, more liquidity is required. The Fed is cornered because allowing forced liquidation risks systemic contagion, while printing to prevent liquidation accelerates metal repricing. Neither path restores equilibrium. Historically, central banks choose to protect institutions first and manage currency consequences later. In an environment of elevated debt and thinning confidence, volatility in silver matters more than it once did because the margin for policy error has narrowed dramatically. When liquidity is injected to defend leverage, wealth is not destroyed. It is transferred. It moves from paper promises to scarce assets, from leveraged exposure to physical ownership, from fragile balance sheets to tangible stores of value. Monetary transitions rarely occur overnight. They unfold through repeated interventions that gradually erode purchasing power. Each liquidity response shifts allocation behavior incrementally until the shift becomes visible. Silver's behavior suggests that we may be approaching that visibility threshold. Physical buyers have not retreated during rallies. Industrial demand remains resilient. Retail investors are holding through engineered dips, and institutional funding stress has already required intervention. That combination signals a potential regime shift. In early repricing phases, volatility frightens participants. In later phases, volatility attracts them. We appear to be moving beyond denial and into recognition. The Federal Reserve's rapid funding support confirms fragility within the system, and fragility alters allocation decisions. Pension funds reassess exposure to overleveraged sectors. Family offices quietly increase hard asset holdings, and sovereign funds diversify currency concentration risk. These rotations do not produce immediate headlines, but they shape price structure through persistent demand and tightening supply. Silver occupies a unique position in this environment because it is historically monetary, industrially essential, and relatively accessible compared to gold. It attracts diverse demand pools simultaneously, stabilizing downside and amplifying upside during stress. The wealth transfer phase begins quietly but accelerates once confidence erosion becomes visible. If every bout of volatility results in liquidity expansion, markets internalize a simple asymmetry. Hard assets benefit mechanically from intervention. If price falls sharply, physical demand rebuilds. If price rises sharply, liquidity injections support currency dilution. Over time, that asymmetry supports repricing. However, such transitions are rarely smooth. Volatility intensifies, corrections become violent, and policy responses grow more visible as authorities attempt to maintain stability. History shows that when leverage collides with scarcity, authorities respond by adjusting rules. They raise margin requirements, alter settlement mechanisms, redefine eligible collateral, or introduce emergency facilities. Each measure is framed as stabilization, yet each confirms stress. Investors must understand that intervention buys time, but does not create surplus. Scarcity cannot be printed, mining cannot scale instantly, and industrial demand cannot vanish without economic contraction. If liquidity continues expanding to defend leveraged exposure, currency dilution accelerates and dilution forces nominal repricing of scarce assets. The Federal Reserve is cornered because defending systemic institutions in a debt-heavy economy through liquidity weakens currency credibility. And weakening currency credibility strengthens hard assets, intensifying leverage stress. This feedback loop becomes increasingly self-reinforcing. Breaking it would require either deflationary collapse, which is politically intolerable, or sustained inflationary debasement, which is economically corrosive but more politically manageable. Historically, policymakers choose debasement. Silver therefore reflects confidence in currency management. When it rises alongside liquidity injections, markets anticipate dilution. When it rises despite intervention, structural demand is at work. When it rises while funding stress persists, systemic fragility becomes visible. The convergence of these factors suggests we are witnessing the early stages of structural repricing rather than a random rally. The system can delay adjustment, but it cannot repeal arithmetic. Leverage combined with scarcity and liquidity expansion results in higher nominal valuations for scarce assets. Silver has exposed pressure within the funding system, and the Federal Reserve has absorbed the initial shock through liquidity. Yet liquidity is not neutral. Over time, it transfers purchasing power toward tangible assets. The question is no longer whether volatility will continue, but whether the system can contain the arithmetic consequences of defending leverage through dilution. History suggests containment is temporary and repricing is eventual.